Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat. Paris milling wheat. 18 weeks ago, my musings on the market were thus, and I quote, "Take a look at the whole big action since the peak in May to date," that is May 2022 I'm talking about, that to date as possibly, just possibly, a very, very large bearish halfway hesitation in the making. To clarify, it is possibly in the making and is not made, not yet. This is a ginormous pattern and one which eventually leads down to something like the 225 area. I'm not prepared to call it that, not yet. However, we may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is the mid-June to date bear channel, currently at 231 to 306, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, then these are worth considering. End of quote. End of quote. These have stood and still stand, as all have been proven to be accurate. I added 11 weeks ago a further short-term pattern, a mid-November to late December 2022 bearish shift pitchfork, and this also worked well in showing the bearish angle of attack for a while. But it got very ragged and I retired it. Instead, I drew a more recent late December 2022 to mid-February 2023 bearish Andrews pitchfork, the one you can see highlighted in dark blue on my daily chart. This has done a better job at capturing the bearish angle of attack, with the current market in between the middle time below, currently at 218, and the upper time above, currently at 237.25. Looking at recent action, we could see the market had previously gotten bogged down in stratified zones on what are now resistances between 258 to 260, 252 to 255, at 250, between 245 and 247, and 238 to 242. Add to this the crossover of the lower bear channel line in bright green with the pitchfork in dark blue, and you can see why perhaps we have seen a sideways market these past 3 weeks. As I said 5 weeks ago, and I quote, "If there were to be an attempt lower in the near future, then that crossover period would likely be the worst time to do it, unless the bearish pressure was stacked high. Far better to wait until they separate their individual ways, and thus their power individually is less than their current combined support." End of quote. This leads me to my final points. What lies below? Initially, I'd look at the 50% absolute Fibonacci line at 218.75. Well, also from below, we have the March 2020 to date uptrend, currently at 208 even. Now, these supports are not in any way as good as the earlier congestions, which are now above as resistances. But it's all we have, and it is to those that we will have to look to. London, UK feed wheat. Back in January this year, as the market punched up through the short medium moving average, currently 198.40, up to the old previous all-time high at 238.80. Well, this old previous all-time high capped the rise from February down to late March. We saw a drop through the January low at 217.25, as well as the 2013 high at 215 even, the 22 low at 206.5, and the March 2013 high at 205.05. Indeed, prices continued declining as if the market was in an area seemingly devoid of significant supports. Yet there were supports, but they gave way under pressure. They were in no particular order: the September 2021 low at 181.70, the possibly powerful 50% absolute Fibonacci line at 308.5, and something I introduced 13 weeks ago, target X at 118 even. You see, I asked the following question back late last year, and I quote, "What are the actions since mid-May to date," so that's mid-May last year to date, to the end of last year, is a huge bearish halfway hesitation, a really, really big one. In that case, we would be looking at potential down to in the 180 even area. Yes, 180 even. I'm not as yet advocating this as a pattern, but it might turn out to be so. It will depend on how the market treats this congestion below. End of quote. 14 weeks ago, I decided to place a potential target X in the 118 area, and this week it was achieved. Or last week actually it was achieved. Now, 5 weeks ago, I pointed out that, and I quote, "What is interesting about Target X is that it is right by the previously mentioned 50% absolute Fibonacci line at 180.5. Perhaps these, however distant they may seem at the time, the influence of these two caused a halt and a move back up. The action also allowed me to draw a new bearish Andrews pitchfork for the very late October 2022 to February 2023 move. Initially, I was not wholly wedded to this pitchfork, as neither the upper time, it's currently 189.35, nor the lower time, currently 154.60, had been tested. However, in the absence of anything else, I was minded to watch this pitchfork, and so far it has been pretty good, indicating the bearish angle of attack." End of quote. Well, so far this pitchfork has continued to be excellent, showing the bearish angle of attack of this market, especially between the upper and middle ties. This leads me to my final point. We have a weekly key reversal down last week. Yet another bearish piece of pressure. So what now on the downside? Well, I drew a dialogue box back in 2019 of congestion between 161.95 and 165.75, occurring between March to April 2019. This seems to be reasonable, as the next area the market may slow in its decline. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.